Welcome to Griffonomics.
Glad to be here.
So I want you to imagine a commercial 5G cell tower. It's positioned on this remote ridge in the Pacific Northwest.
Okay, setting the scene.
Right. And it's 2 in the morning. Suddenly, there's this microfracture in a cooling component, and it causes a fractional temperature spike in the tower's base station.
Which is usually a massive headache.
Oh, exactly. Historically, here's what happens next. Right? Alarms start blaring in some centralized network operations center halfway across the country.
Yeah, some bleary-eyed human technician sees a red flashing light on a dashboard.
Right. They try a manual reboot. It fails. They write up a diagnostic ticket, and then they have to dispatch a physical truck to roll out the next morning.
Taking, 12 hours and thousands of dollars to fix.
Exactly. But today, before a single human even registers that temperature spike, this invisible digital entity intercepts the anomaly.
It diagnoses the failing component on its own.
Yes, and it autonomously reroutes the region's 5G traffic to neighboring towers so there are no dropped calls. Then it checks the local warehouse for a replacement cooling unit, reserves the part, and schedules a technician's route for the morning shift. The whole network basically heals itself in under 40 seconds.
I mean, that is just wild. It is the difference between a system that merely records a problem and a system that actually solves it.
Yeah.
And that really is the crux of what we are unpacking today.
Because today we are doing a massive, extensive strategic inflection analysis of ServiceNow. We're looking at the company right at this specific moment in time, April 22, 2026.
And it's a fascinating moment.
It really is. The mission of this deep dive is to deconstruct their aggressive evolution from what the industry traditionally viewed as, standard IT ticketing software.
Right, the old help desk stuff.
Yeah, moving from that into what they are now calling an autonomous enterprise-wide system of action, or an agentic control tower.
I love that phrase, agentic control tower.
We're pulling from a huge stack of sources today to figure out how this is actually happening. We've got their fresh Q1 2026 earnings call transcripts.
We have their detailed financial reports.
And all the voluminous documentation surrounding their historic $7.75 billion acquisition of a company called Armis.
Plus those brand new press releases that just dropped today from the Google Cloud Next conference.
Exactly.
And for anyone listening right now, whether you are an institutional investor trying to model out software valuations, or maybe a tech professional navigating the changing landscape of your industry.
Or just insanely curious.
Right, or just insanely curious about the future of work. Understanding this transition matters to you.
Because understanding how artificial intelligence is shifting from, novelty chatbots that write emails.
Yeah, the old parlor tricks.
Exactly.
Yeah.
Shifting from that to autonomous interconnected agents that are essentially running the underlying workflows of global GDP. That is arguably the most crucial technological transition of this decade.
It absolutely is.
So let's start with the foundation. Because before we can even begin to conceptualize how these AI agents are taking over global workflows, we really need to map out the infrastructure they're standing on.
Right, because you can't just drop an autonomous AI into a Fortune 500 company and tell it to run things. It needs a massive, stable platform.
Yeah, and the sources continuously refer to ServiceNow as the platform of platforms.
Which is a bold claim.
Very bold. So we need to define what that actually looks like in practice because, this isn't just a simple application sitting on a corporate desktop.
No, not at all. To conceptualize ServiceNow in 2026, you basically have to entirely discard that outdated notion of them as an IT help desk.
Right.
That is their origin story, sure, but it is not their current reality. Today, they function as the central nervous system of the enterprise.
The central nervous system.
Yeah, they're orchestrating workflows across more than 800 disparate siloed systems.
800, wow.
Think about a massive multinational corporation. They run on this chaotic, fragmented web of hundreds of different software applications, right?
You have Workday for HR, Salesforce for customer relations, SAP for supply chain.
Exactly. Oracle for finance.
Mm-hmm.
And these systems notoriously do not talk to each other smoothly.
They really don't.
But ServiceNow sits a layer above all of them, acting as this connective tissue. To put some concrete numbers to the sheer scale of this operation, their platform currently manages an estimated $85 to $95 billion workflows.
Right, 85 to 95 billion?
Yes, in flight at any given moment,
God.
processing nearly 7 trillion transactions annually.
Okay, let's unpack this. It's like ServiceNow is the central nervous system of a company, while other software programs are just individual organs.
That is the perfect analogy, yes.
But if they are this deeply embedded, acting as the brain and the nerves, how hard is it for a company to just rip them out if they want to switch vendors?
Well, the sources give a staggering metric for that. They have a world-class 98% renewal rate.
98%.
Ah.
That's almost unheard of in enterprise software.
And CEO Bill McDermott actually claims that it currently costs a company 10 times more to attempt to rip ServiceNow out of their infrastructure than it does to simply maintain the annual contract.
Wow.
Yeah, when you are actively managing 95 billion workflows across 800 underlying systems, you cease to be a software vendor.
You become the operational reality of the enterprise.
Exactly. Ripping them out wouldn't just be an IT project, it would be a catastrophic corporate organ rejection. The whole business would just grind to a halt.
But there has to be a structural reason why they can be this embedded, right? The software architecture piece is crucial here because almost the entire software as a service industry operates on multi-tenancy.
Yes, which is fundamentally different from what ServiceNow does.
Right. Companies like Salesforce or Workday, they throw thousands of customers onto a single shared database structure to save on computing costs.
It's like an apartment building.
Yeah, exactly. You have a lock on your individual apartment door, so your data is secure from your neighbors. But you all share the same plumbing, the same electricity grid, and the same foundation.
And if the building's main water line breaks, everyone loses water.
Right. But the sources highlight that ServiceNow built a single-tenant cloud. How does that fundamentally change the value proposition?
Well, if multi-tenancy is an apartment building, ServiceNow's single tenancy is a fully detached house. You get your own plumbing, your own power grid, your own foundational architecture.
Okay.
But it goes deeper than that, especially when we look at the macroeconomic landscape of 2026. It's not just about having a detached house. It's about having the ability to build that detached house entirely off the grid.
Off the grid.
Yeah, inside a heavily guarded, walled fortress within your own country's borders. You can run your specific instance of ServiceNow in any hyperscaler cloud, like AWS, Google, or Microsoft Azure.
Sure, the usual suspects.
But you can also run it in a government-approved sovereign cloud. Or you can even take it entirely offline and run it in your own private, air-gapped, on-premise data center.
Which brings us to the geopolitical reality highlighted in the earnings transcripts.
Right.
Because the sources, quote, CEO Bill McDermott, specifically referencing the, quote, fratricidal relations between countries right now.
It's a very tense global environment.
Very. We are operating in an era dominated by intense data localization laws, strict data sovereignty requirements, and massive privacy restrictions.
And that is exactly why single tenancy is such a massive strategic advantage right now.
Because you can wall yourself off.
Exactly. I mean, if you are a major European bank subject to the strictest interpretations of the GDPR, or if you are a defense contractor manufacturing munitions in the Middle East,
you probably can't use a shared cloud.
Exactly. You might be legally prohibited from putting your highly classified operational data into a shared multi-tenant cloud that ultimately routes back to servers in Silicon Valley. You require absolute isolated control. Your data must stay within your national borders. Because ServiceNow offers that architectural isolation, they are completely insulated from these complex international data sovereignty wars.
Because a multi-tenant competitor can't just flip a switch to offer that.
No, they cannot simply replicate that level of isolation without entirely rebuilding their underlying code base from scratch. It really creates a structural monopoly in highly regulated industries.
Okay, so we've established the fortress. We understand the massive, inescapable web of connections they maintain across the global enterprise.
A platform.
Right. But having the pipes is only half the battle. The current mandate is pumping artificial intelligence through those veins.
Yes.
And what we are seeing is a complete rejection of what the industry calls sidecar AI.
Sidecar AI is the trap that the vast majority of legacy software companies fell into over the past 3 years.
The fragmentation problem.
Exactly. They watched the generative AI boom, panicked, licensed a standard large language model from OpenAI or Anthropic, and awkwardly bolted it onto the side of their disconnected legacy systems.
It's the illusion of intelligence, really.
Yeah.
Right? The LLM might be incredibly articulate. It can write a flawless email or summarize a 50-page PDF in seconds.
Let's generate a marketing slogan.
Right. But it is fundamentally blind. It completely lacks enterprise context.
Blind is the perfect word. An off-the-shelf LLM does not inherently know a company's live approval chains. It doesn't know who the VP of finance is today versus who it was yesterday.
It doesn't understand the compliance rules.
Right. If you have heavily regulated IT compliance rules in a pharmaceutical company, it doesn't know them.
So if a mid-level manager asks this sidecar AI to provision a new secure server for a confidential project, the AI can enthusiastically output a beautifully formatted 10-step guide on how a human might go about doing it.
Exactly. But it cannot actually execute the task. It has no authority, no contextual awareness, and no secure pathway to push the buttons.
And ServiceNow's mandate is diametrically opposed to that. The phrase they use repeatedly in their annual report is AI that thinks in workflows that act.
They are relying on what they call their context engine.
Right. Here's where it gets really interesting. Relying on a standalone LLM is like reading a textbook on driving, but ServiceNow's context engine is like driving a car with a GPS, blind spot monitors, and live traffic updates.
It actually knows what's happening on the road.
Exactly.
Yeah.
But to ground an AI in the operational reality of a massive enterprise, it needs access to an unfathomable amount of data. And historically, that introduces a massive security and logistical nightmare.
Because if you wanted an AI to analyze data from HR, finance, and supply chains simultaneously, you had to physically extract that data from those individual databases.
Right. You duplicate it and dump it into a massive centralized data lake so the AI can read it.
And that data extraction process is fundamentally broken for modern AI. Moving massive petabytes of data is incredibly slow.
Plus, the egress fees from cloud providers are huge.
Huge. And most critically, it creates a terrifying security and governance vulnerability. The moment you copy a database, you have instantly doubled your attack surface.
You now have two places a hacker can breach.
Yes. Furthermore, the data you copied is instantly out of date.
Because things change by the minute.
Right. If you copy the inventory database at 9 a.m. and the AI makes a decision at 9:05 a.m., it is operating on stale information.
Which makes their implementation of the zero-copy data fabric so critical to this agentic control tower vision. It sounds like pure marketing jargon, but the technical reality of it solves that exact data drift problem.
The zero-copy data fabric is powered by their newly released RaptorDB architecture. What it does is establish secure, direct integrations with massive external cloud databases.
Specifically AWS Redshift and Google Cloud BigQuery, right?
Yes. Instead of forcing a company to copy their massive data lakes into ServiceNow, RaptorDB allows ServiceNow's AI agents to reach into those external databases, read the data, understand the context, and execute an action.
Without ever moving or duplicating the original data.
Exactly. It is a live, direct read at the exact moment of execution.
So an autonomous agent can instantly reach into the HR database sitting in Google Cloud to verify an employee's clearance level, reach into the IT database sitting in AWS to check hardware availability, and provision a laptop in a fraction of a second.
Leaving the underlying data exactly where it lives.
That's incredible.
It is. And this highlights a massive macroeconomic shift in the broader AI narrative that investors are just waking up to in 2026. For the last 4 years, the entire market has been violently obsessed with the foundational models.
The trillion-dollar question was always who has the smartest base intelligence.
Right. Is it OpenAI's GPT-5, Google's Gemini, or Anthropic's Claude? But the sources make a fascinating contrarian point here.
Which is what?
Base intelligence is rapidly commoditizing. All the major models are hitting a ceiling of relative parity in their reasoning capabilities.
So being the smartest isn't enough anymore.
Exactly. The true defensible competitive differentiator in 2026 isn't owning the smartest brain. It is possessing governed, autonomous execution.
It is owning the trusted workflow data fabric that allows that brain to actually move its hands and do the work securely.
Precisely.
But, AI models, even with a context engine, don't inherently have hands. They can think, they can see the data via zero copy, but they still need to interface with humans and interact with physical infrastructure.
Right.
And that realization explains why ServiceNow couldn't just rely on organic internal engineering to build out this platform. They had to go out and buy the hands.
Yes, they did.
Over the last several months, they've executed a historic, aggressive, rapid-fire M&A blitz.
We are looking at the rapid integration of 3 massive companies: Moveworks, Veza, and an absolute blockbuster $7.75 billion acquisition of Armis.
And this was not a traditional corporate shopping spree, right?
Not at all. Usually, a mature company buys declining legacy software just to pad their revenue numbers.
Right.
But these were highly specific surgical acquisitions designed to rapidly assemble the missing puzzle pieces of the autonomous workforce.
Let's break down the mechanics of these pieces, starting with Moveworks. ServiceNow acquired them for roughly $2.4 billion. The documentation refers to Moveworks as the employee conversational front door.
Think about the friction of the traditional enterprise experience. If a mid-level employee has a problem, say, they need specialized software installed, or they have a complex payroll discrepancy.
They have to figure out which of the 800 systems they need to log into.
Exactly. They have to find the correct internal portal, fill out a rigid drop-down menu form, submit a ticket, and then wait in a queue for a human to read it.
Which takes forever.
But Moveworks obliterates that friction. It provides a single, unified natural language interface for the nearly 200 million employees sitting across ServiceNow's customer base.
So the employee simply types in conversational English or Spanish or Japanese. Like, I need access to the Q3 financial forecasting portal.
Or my monitor is flickering and I need a replacement. Moveworks possesses the natural language understanding to instantly parse the intent of that chaotic human sentence.
Translate it into machine logic.
Yes, and trigger the autonomous workflows within ServiceNow to solve the problem.
So Moveworks acts as the ultimate digital concierge. It takes the chaotic human request and translates it into an actionable command.
Right.
But, that introduces a terrifying vulnerability.
Look, absolutely.
I mean, if the AI can now reach into any system and execute commands based on natural language, couldn't a disgruntled intern casually ask the AI to download the CEO's proprietary compensation package?
Or authorize a $1 million vendor payment.
Exactly.
That exact nightmare scenario is precisely why they simultaneously dropped $1.25 billion to acquire Veza.
Veza. Okay, how do they fit in?
If Moveworks is the concierge taking your request, Veza is the heavily armed bouncer checking your credentials at the vault door. Veza is an AI-native identity security platform.
Because traditional identity governance just checked if you had a password.
Right. Yeah, and as AI agents begin executing tasks autonomously, that old model completely breaks down. Veza maps every single granular permission, every access path, and every authorization level across human identities, machine identities, and crucially, AI agent identities.
Wow. So before the Moveworks triggered AI can retrieve that financial document or authorize that payment, Veza instantaneously verifies it.
It makes sure that the requesting human and the executing AI agent possess the explicit cryptographic authority to perform that specific action.
It ensures the AI only operates within its strictly defined blast radius.
Precisely.
Okay, so writing a $2.4 billion check for Moveworks and a $1.25 billion check for Veza makes strategic sense for a software company. It secures the digital front door and locks down digital identities.
But then we get to the crown jewel of this M&A blitz.
Right, and it is a massive pivot, a staggering $7.75 billion all-cash acquisition for Armis.
They are stepping entirely outside of the traditional IT domain and diving headfirst into OT operational technology.
Because securing a corporate email server is a completely different universe than securing factory floor robotics or hospital MRI machines.
It is the most aggressive TAM expansion, total addressable market expansion in the company's history. Information technology, IT, is the digital world. Laptops, servers, cloud applications.
And operational technology, OT, is the physical world.
Yes. The automated assembly line at an automotive plant, the connected HVAC systems of a 50-story skyscraper, the IoT sensors tracking cold chain pharmaceuticals on a cargo ship.
And historically, OT has been a massive, unmanaged blind spot for corporate cybersecurity.
Huge blind spot. These physical machines often run on outdated, proprietary, air-gapped legacy protocols that modern IT software just cannot comprehend.
And Armis fixes that.
Armis is arguably the global leader in real-time asset discovery and cyber exposure management for the physical world. It maps and monitors every single unmanaged physical device on a network.
Okay, let's run a mechanical walkthrough of how these three acquisitions, Moveworks, Veza, and Armis, actually synergize with the core ServiceNow platform to create this system of action.
Sure.
Imagine a massive automotive manufacturing plant.
Perfect scenario. So on that factory floor, you have a highly specialized multi-million-dollar robotic welding arm. Embedded in that arm is an IoT vibration sensor.
Okay.
At 10 a.m., the sensor detects a microscopic anomaly, a vibration frequency that deviates from the baseline by 2%.
But the robotic arm doesn't have an IT ticketing portal. It can't send an email.
Exactly. But Armis is actively monitoring the physical telemetry of that plant. Armis instantly catches the anomaly and identifies it as an impending mechanical failure.
A failure that could halt the entire assembly line within 48 hours.
Right.
So Armis sees the physical problem. It then injects that telemetry data into the central ServiceNow nervous system.
And that's when ServiceNow's autonomous agents take over. The AI consults the zero-copy data fabric to check the live inventory database.
To see if they have the part.
Yes, and it confirms a replacement servo motor is in the local warehouse. But before the AI can order the factory floor to shut down the welding arm for maintenance, Veza intercepts the command.
The bouncer steps in.
Veza verifies that the specific AI agent attempting the shutdown has the authorized permissions to halt operational manufacturing equipment.
Once Veza clears the identity check, the AI proceeds.
It reserves the physical part, checks the scheduling system for certified maintenance technicians, and then uses Moveworks to send a natural language alert to the mobile device of the floor manager.
Saying something like, Robotic Arm 4 is projecting a critical failure. Replacement parts secured. Technician dispatched for 2 p.m. downtime. Approved.
Yes, the manager taps approve, and the crisis is averted before a single human had to manually search for a problem.
That is the complete bridge from digital intelligence to physical execution.
It really is.
And the internal data they are releasing regarding the efficiency of these level 1 AI agents is staggering. We aren't talking about a 5% improvement in productivity.
No, an autonomous AI specialist can resolve a complex HR or IT issue end-to-end in under 20 minutes, compared to the typical 2-day turnaround time for a human agent waiting in a queue.
That is a 99% reduction in resolution time.
And internally, ServiceNow is practicing what they preach. They are currently deflecting 90% of their own internal employee requests using this autonomous framework.
Wow, 90%.
Yeah.
And the financial momentum attached to this is undeniable. Their generative AI product suite, branded as Now Assist, is breaking internal records.
It surpassed $600 million in annual contract value, or ACV, in late 2025.
Right, and by their fourth quarter, they were seeing 10x year-over-year growth in massive enterprise deals that included 5 or more AI products.
Based on this trajectory, they are on track to significantly exceed a $1 billion ACV run rate purely from AI in 2026.
Which is why management is so confident that they are publicly dropping hints about targeting a $1.5 billion AI run rate in the near term.
Yes, the growth is explosive.
But I have to inject some skepticism here, because the timeline of this M&A integration raises massive red flags.
It is very fast.
Extremely. They integrated 3 massive, deeply complex companies, Moveworks, Veza, and Armis, into their core platform in just 20 days.
Ray.
I mean, anyone who has survived a corporate merger knows that 20 days is barely enough time to integrate the HR payroll systems and figure out the email aliases, let alone seamlessly fuse complex AI identity architecture and physical OT telemetry.
Analysts on the earnings call were aggressively questioning this.
Exactly. Is this real functional integration? Or is this financial engineering? Wait, they integrated 3 massive companies, Moveworks, Veza, and Armis, into their platform in just 20 days?
Yeah.
Is this just a case of buying revenue to mask slowing organic growth?
It is the most common critique of any aggressive M&A strategy, and CEO Bill McDermott met it head-on during the call.
What did he say?
He was adamant that this was not a defensive revenue-buying exercise. He clarified the profile of these companies. While Armis was a massive purchase, these are fundamentally young, highly innovative technology tuck-ins.
So they weren't acquired to artificially inflate the quarter's revenue sheet.
No, they were acquired specifically for their underlying intellectual property, to acquire the literal code necessary to finalize the architecture of the AI control tower. McDermott explicitly pointed out to the analysts that management did not even bake the projected revenues of Moveworks, Veza, or Armis into their original Q1 guidance numbers.
Oh, wow. So even without that acquired revenue, the core platform organically grew and delivered a massive beat.
Exactly.
And as for the impossibly fast 20-day integration timeline,
that speed is the ultimate vindication of the single-tenancy architecture we discussed at the very beginning.
right, because they aren't dealing with a multi-tenant mess.
When a company operates on a fragmented multi-tenant spaghetti code of legacy databases, integrating a newly acquired company takes years of painful API hard coding.
But because ServiceNow operates a unified single data model platform, It functions more like an iPhone operating system.
Plugging in Moveworks or Veza is less like a corporate merger and more like installing a highly complex app onto an existing, perfectly compatible operating system.
The foundation was already built to receive them.
Exactly.
All right, so the technology is undeniably fast, the platform is integrated, and the use cases sound like science fiction made real. But that brings us to a critical inflection point in our analysis.
Because the technology might be revolutionary, but how does it translate into a sustainable business model?
Exactly. Because right now, the broader software market is gripped by a creeping dread. Wall Street analysts are aggressively pushing a narrative that they're calling the SaaS apocalypse.
The SaaS apocalypse is arguably the most dominant macro narrative in the enterprise software space right now. Firms like UBS have been releasing dire reports about the existential threat AI poses to traditional software companies.
The fear is twofold, right?
Yes. The first is a simple macroeconomic reality, budget diversion. Enterprise IT budgets are not infinite, they are relatively fixed.
So if a Fortune 500 CIO suddenly has to spend hundreds of millions of dollars acquiring AI infrastructure, securing massive GPU clusters, and licensing foundational models just to keep up with the AI arms race.
They have to source that capital from somewhere.
Right. And the fear is that they will ruthlessly cannibalize their core software budgets, terminating contracts with legacy SaaS vendors to fund the AI transition.
But the second, much deeper fear isn't just about tightened budgets. It's about the fundamental destruction of the software licensing model itself.
Right, because for 2 decades, companies like Salesforce, Microsoft, and ServiceNow built massive empires on the per-seat pricing model.
If a logistics company employs 1,000 human customer service reps, they're forced to buy 1,000 software licenses.
But if ServiceNow's autonomous AI agents are suddenly capable of doing the work 99% faster, that logistics company might downsize its human workforce to 500 reps.
They then cancel 500 software licenses?
Exactly. In a cruel twist of irony, by making their software incredibly efficient, the SaaS company effectively destroys its own recurring revenue model.
The AI literally kills the seats.
So how is ServiceNow defending against the cannibalization of their own business?
They are executing what the financial analysts and the sources are calling the pricing pivot.
The pricing pivot.
And this leads us to perhaps the most vital foundational statistic in this entire deep dive.
Actually, Ani.
As of Q1 2026, 50% of ServiceNow's net new business is officially non-seat-based.
50%. Wow. So they have effectively decoupled half of their new growth from human headcount.
Exactly. They recognized the SaaS apocalypse narrative early and preemptively shifted away from a pure human seat dependency.
They are transitioning to a hybrid, consumption-based commercial model.
Yes. They still charge traditional seat licenses for the human managers and engineers who log into the platform. But the explosive growth engine is now entirely focused on monetizing the AI consumption itself.
They sell what they call tokens or assist packs.
Every single time an autonomous agent resolves a password reset, or Veza authenticates an identity, or Armis detects an anomaly, it burns a microfraction of a token.
Furthermore, they are heavily pricing their contracts based on the sheer volume of infrastructure they manage and the physical hardware assets they track.
So what does this all mean for their revenue model? It sounds like they are shifting from a flat buffet fee to charging per plate, plus charging you for the chefs.
That's a great way to think about it. It is a brilliant pivot. If that logistics company fires 500 human reps, they lose the seat revenue. But the volume of work hasn't changed.
Right. The 10,000 customer complaints still need to be processed.
Now, the AI is processing them. The company burns through millions of tokens, and ServiceNow actually makes more money processing the work autonomously than they did renting out the interface to humans.
They are monetizing the ultimate outcome, not just the access to the tools.
And we are seeing the massive scale of this consumption model play out in the ecosystem partnerships. Because this isn't happening in a vacuum.
No, not at all.
On April 22, directly coinciding with their earnings release, major news broke out of the Google Cloud Next conference. ServiceNow and Google announced a radically deepened strategic partnership.
Specifically focused on integrating ServiceNow's autonomous agents directly with Google's Gemini Enterprise AI platform.
Right. The press releases focus heavily on the underlying framework making this possible. They use the acronyms MCP, Model Context Protocol, and A2A, Agent-to-Agent Communication.
We need to translate this because this isn't just two companies agreeing to co-market their products.
No, this is deep underlying technical integration. What is the mechanism of MCP?
To understand MCP, think of it as a universal instantaneous translator for artificial intelligence.
Okay.
Historically, if you wanted Google's AI to trigger an action in ServiceNow software, human engineers had to spend months writing brittle, custom API code to bridge the two specific systems.
And if one system updated, the API broke.
Exactly. Model Context Protocol standardizes this. It provides a universal language that allows a highly intelligent foundational model, like Google's Gemini, to perfectly format a command so that ServiceNow's specific execution agents can instantly understand and act upon it.
That's amazing. And agent-to-agent, or A2A communication, takes it a step further.
It means a Gemini agent operating inside Google Cloud can literally talk to a ServiceNow agent, negotiate an outcome, exchange live intelligence, and coordinate complex actions across entirely different enterprise boundaries.
Without a single human intermediary writing code.
Exactly. John Azian, a senior executive at ServiceNow, explicitly stated during the conference that they share a deep conviction with Google that the future of AI cannot be a series of walled gardens.
It must be built on open, interoperable platforms.
Right. And the theoretical implications of MCP are fascinating, but the real-world use cases they unveiled at Google Cloud Next are where the true commercial value becomes obvious.
Let's look at the first major scenario they highlighted: 5G autonomous network operations. We touched on a simplified version of this in the introduction, but the actual technical mechanism of these two AI behemoths working together is incredible.
Let's walk through the exact mechanics of how Gemini and ServiceNow interact to heal a telecommunications network. Imagine a Tier 1 telecom provider managing a vast 5G infrastructure.
Okay.
Deep within the network routing, a subtle configuration error begins degrading signal quality in a dense urban sector.
It's not a hard crash, so traditional alarms don't immediately trigger, but customers are experiencing dropped calls.
Right. Now, Google's Gemini agents are continuously ingesting and analyzing the massive petabyte-scale telemetry data flowing through the telecom's Google Cloud infrastructure.
And because Gemini is a massive foundational model, it excels at pattern recognition.
Exactly. It detects the microscopic degradation and correlates it to a specific routing node.
But Gemini, brilliant as it is just the brain sitting in the cloud. It doesn't have the hands to fix the router.
Precisely. This is where the agent-to-agent communication fires. Gemini utilizes the Model Context Protocol to instantly package the diagnostic data, the precise location of the failing node, and the recommended configuration fix.
And it shoots that packet directly to a ServiceNow AI agent.
Yes. The ServiceNow agent receives the intelligence and immediately consults its live CMDB, the configuration management database.
It maps the failing node against every active customer service level agreement to calculate the exact financial impact of the degradation.
And it verifies that deploying the fix won't accidentally take down a local hospital's network.
Crucial step. Once the blast radius is confirmed, the ServiceNow agent autonomously deploys the network function change, rewriting the router's configuration.
Then it communicates back to Gemini to validate that the signal quality has returned to baseline.
It is a closed-loop, self-healing architecture.
The network fixes itself before the Network Operations Center even finishes brewing their morning coffee.
Wow. And the second use case, they debuted Bridges, that digital-to-physical gap we discussed with the Armis acquisition. They unveiled an AI-powered predictive maintenance integration for the retail sector.
Think of a massive national grocery chain operating thousands of locations.
Right. A single commercial refrigeration unit failing can result in tens of thousands of dollars in spoiled inventory, severe operational disruption, and massive health code liabilities.
Huge risk. In this integrated scenario, Google Cloud's BigQuery ML, their machine learning engine, is continuously analyzing live telemetry data streaming from temperature and vibration sensors inside every refrigerator across the country.
The machine learning models aren't just looking for failures. They are trained to detect the microscopic precursors to failure.
Like a fractional drop in coolant pressure or a slight change in the hum of a compressor motor.
And because of that zero-copy data fabric we unpacked earlier, ServiceNow's platform can see those microscopic anomalies the exact second Google's ML detects them, without needing to extract or duplicate the massive telemetry logs.
That is the crucial link. The second Google's BigQuery flags the precursor anomaly, it surfaces the recommendation via zero copy.
And ServiceNow's autonomous workflows instantly ignite.
The system triages the severity, identifies the exact make and model of the failing compressor, autonomously checks the regional warehouse for replacement parts, reserves the inventory.
Then it cross-references the schedules of certified HVAC technicians in the area and dispatches the closest technician with a mobile device loaded with a guided, AI-generated repair playbook.
The technician arrives at the store and replaces the part before the store manager even realizes the unit was under strain.
The system completely eliminates unplanned downtime.
When you break down these scenarios, autonomous 5G networks and precognitive grocery supply chains, you understand exactly why they are relentlessly pushing the AI control tower narrative.
Absolutely. But, strategy, M&A, and groundbreaking technological partnerships are only one side of the coin.
Ultimately, we have to look at the scoreboard.
Right. Wall Street doesn't deal in narratives, it deals in hard numbers. So let's turn our attention to the financial realities and the deeply complex Q1 2026 earnings review. All of this innovation has to manifest in the bottom line.
And at first glance, the top-line numbers for Q1 2026 were exceptionally strong. By almost every traditional metric, it was a classic beat-and-raise quarter.
Total revenue came in at $3.77 billion, which represents a massive 22% year-over-year growth rate.
And when you dig into the core engine of their business, subscription revenue, they posted $3,671 million.
The financial reports highlight that the subscription revenue represented a 19% growth in constant currency.
We should probably translate that for listeners.
Yeah, for listeners who might glaze over when analysts throw around Forex jargon, constant currency is a vital metric for global companies. If the US dollar suddenly becomes incredibly strong compared to the euro, the revenue of ServiceNow earns in Europe looks smaller when converted back to dollars on the balance sheet, even if they sold the exact same amount of software.
The constant currency metric strips out the noise of exchange rate fluctuations to reveal the true underlying operational health of the business.
And 19% true growth at a nearly $4 billion quarterly run rate is massive scale.
It is massive. But Wall Street is fundamentally forward-looking. They care about what happened yesterday, but they trade based on what will happen tomorrow.
Which is why the RPO metric is heavily scrutinized. RPO stands for Remaining Performance Obligations. Let's break down RPO because it is the ultimate health indicator for an enterprise SaaS business.
Essentially, RPO represents their backlog of contracted revenue that has been legally signed but hasn't yet been recognized on the income statement.
Because the service hasn't been fully delivered over the life of the multi-year contract.
Right. If a company signs a 3-year deal for $30 million, the revenue isn't recognized all at once, but the $30 million immediately beefs up the RPO.
And in Q1, ServiceNow's RPO surged by 25% year over year to a staggering $27.7 billion.
That is a massive reservoir of highly predictable future revenue.
Furthermore, their current RPO, which is the portion of that backlog they expect to explicitly recognize as revenue within the next 12 months, hit $12.64 billion.
To cap off the strong print, management didn't just beat the Q1 estimates, they confidently raised their full-year 2026 subscription revenue guidance by $205 million.
Now forecasting an annual total between $15.735 billion and $15.775 billion.
Okay, so they beat top-line revenue, they grew subscriptions by 19% in constant currency, their backlog swelled to nearly $28 billion, and they raised full-year guidance.
By every logical, surface-level assessment, the stock should have surged.
But, and this is the massive glaring paradox of this earnings cycle, despite printing a phenomenal quarter, the market absolutely punished them.
Post-market trading saw the stock violently drop somewhere between 12 and 14%.
Right.
If the numbers are this good and they raise guidance, why did the market punish them with the double-digit stock drop? Are investors just getting jittery about these massive $4 billion loans and margin compression?
Yes, because while Wall Street loves top-line growth, it is ruthlessly obsessed with margins and debt, particularly in the macroeconomic climate of 2026.
The market looked past the revenue beat and hyper-focused on the staggering cost of the M&A blitz we discussed earlier.
Let's look at the harsh financial mechanics of the Armis acquisition. When a company decides to execute a $7.75 billion all-cash acquisition, they require immediate massive liquidity.
ServiceNow used a significant portion of their cash on hand, but to cover the spread, they were forced to enter into a massive $4 billion unsecured term loan agreement.
Taking on $4 billion in new corporate debt is guaranteed to make the market nervous, especially in an environment where interest rates are significantly higher than the zero interest rate phenomenon of the previous decade.
Debt is expensive to service, And furthermore, absorbing a company like Armis isn't free. Armis isn't a pure high-margin software business. They deal with the messy reality of physical OT hardware integrations.
Precisely. The CFO, Gina Mastantuono, had the difficult task of guiding the street through some significant, immediate margin headwinds.
She explicitly detailed that the rapid integration of Armis caused a temporary 75 basis point compression to their operating margins.
Let's translate basis points for clarity. 1 basis point is 1/100%.
So a 75 basis point compression means their operating margin shrank by 0.75%.
That might sound like a rounding error to a layperson, but when you're dealing with nearly $16 billion in annual revenue, stripping nearly a full percent off your operating efficiency equates to hundreds of millions of dollars in lost profitability.
It brought their overall gross margin outlook down to 81.5%.
And arguably, the metric that triggered the harshest sell-off from cash flow-focused institutional investors was the impact on their free cash flow.
The M&A integration costs caused a severe 200 basis point hit, a full 2% reduction to their free cash flow margins.
The algorithmic trading models and the institutional bears saw the $4 billion debt load, modeled out the compressed operating margin, saw the reduced free cash flow, and executed a massive sell-off,
completely ignoring the long-term strategic value of the TAM expansion.
But management's stance on the earnings call was defiant.
They are heavily messaging that this margin compression is entirely temporary, a necessary short-term financial hit to secure long-term architectural dominance.
They are claiming they can essentially engineer their way out of the margin dip using their own technology.
Yes, they are heavily relying on a massive internal initiative they call Now on Now.
Essentially, ServiceNow is acting as patient zero for their own autonomous AI agents. They are aggressively deploying Moveworks, Veza, and the core generative AI platform internally to drive massive operational efficiencies within their own workforce.
By automating 90% of their own internal IT, HR, and development workflows, they are structurally lowering their own operating costs.
Because of the massive internal leverage generated by the Now on Now initiative, combined with the expected scaling of the new acquisitions, management is confidently projecting that both operating margins and free cash flow margins will fully normalize and resume their upward expansion trajectories by fiscal year 2027.
They are asking the market to trust that they can swallow a $7.75 billion hardware-adjacent company and digest it into a high-margin software asset within 12 months.
Which perfectly transitions us into the broader context of market skepticism and existential risks.
Because the temporary margin compression from an acquisition is just one piece of the puzzle. The sources point out a much wider, more persistent cloud of skepticism hanging over the stock.
We noted the sharp drop immediately following the earnings call, but the Stifel analyst downgrade report included in the sources provides brutal context.
What does it say?
Despite printing 20% plus revenue growth for consecutive quarters, the stock is actually down over 40% over the trailing 6-month period.
A 40% haircut on a dominant enterprise software company points to deep structural fears beyond just a single expensive acquisition.
Yes.
What are the macroeconomic headwinds driving that sustained pressure?
The first and perhaps most uncontrollable major headwind is severe geopolitical instability, and we are seeing it have a direct, quantifiable, and immediate impact on their recognized revenue.
During the Q1 call, management had to reveal that the ongoing escalating regional conflicts in the Middle East caused a direct 75 basis point hit to their Q1 growth metrics.
This requires a bit of accounting context because a casual observer might wonder how a regional conflict halfway across the globe instantly hits the quarterly revenue sheet of a cloud software company based in California.
Right. If it's a subscription cloud model, shouldn't the revenue just keep ticking away smoothly?
In a pure cloud deployment, yes. The revenue is recognized ratably, a little bit each month over the life of the contract. However, as we discussed with their single tenancy advantage, ServiceNow does massive business with highly secure, regulated entities like sovereign governments, national defense contractors, and regional banking conglomerates.
And due to security protocols in volatile regions, these specific clients mandate on-premise deployments.
They physically install the ServiceNow software on massive servers bolted into their own secure data centers. Under standard GAAP accounting rules, on-premise software licenses are treated differently than cloud subscriptions.
Because the software is physically delivered to the client all at once, the revenue for that massive contract is often recognized upfront in a massive lump sum in a single quarter.
So when the regional conflict escalated, those massive sovereign governments understandably paused their IT infrastructure deployments to focus on national security.
The massive lump sum deals were delayed, which created an immediate, glaring vacuum in the Q1 growth numbers.
Exactly. Management was very careful to stress that these massive contracts are not lost to competitors. They are merely delayed in the pipeline until the regional instability cools.
But Wall Street operates on 90-day cycles, and a delay is treated as a miss.
Furthermore, the sources point to a broader domestic issue, a severe federal spending slump. Governments across the globe, including the U.S., are tightening their belts in response to massive national debt loads and higher borrowing costs.
If you are selling massive, multi-million-dollar IT overhauls, a tightening federal budget is a terrifying prospect. Management frequently touts the platform as the unavoidable operating system of the enterprise.
But if the stock is down 40% in 6 months, and global conflicts and federal belt tightening are actively delaying their massive deals.
We have to ask the hard question. They call themselves the unavoidable operating system, but with the stock down 40% over 6 months and global conflicts directly delaying their deals, are they actually too exposed to macro shocks to be a safe harbor?
If they touch every part of the global economy, doesn't that mean every global crisis hits their balance sheet?
Exactly.
It is the ultimate double-edged sword of achieving ubiquitous scale. When you are the central nervous system of global GDP, you cannot outrun global macroeconomic shocks. A tightening of U.S. federal agency budgets or a regional conflict in the Middle East will absolutely ripple through your pipeline.
However, their defense, and the reason long-term bulls remain confident, is the unparalleled stickiness of the platform. We return, again, to that 98% renewal rate.
Amidst severe macro turbulence, a multinational corporation might delay a massive experimental new deployment of an AI product.
But they're absolutely not shutting down the core platform that is actively keeping their 95 billion foundational workflows running.
Furthermore, while the federal spending environment is tough, the sources point out that ServiceNow is aggressively deepening its integration into the fabric of the government's digital operations. For example, the newly acquired Moveworks solution just achieved FedRAMP moderate authorization.
That authorization is a massive barrier to entry. It legally allows them to provide secure, autonomous conversational AI directly to public sector agencies.
Precisely. They are embedding themselves so deeply into the bureaucratic machinery that they become fundamentally recession-resistant over a multi-year horizon, even if they take hits on quarterly new deal flow.
We also have to address the elephant in the room regarding enterprise software valuation, stock-based compensation, or SBC.
It is a major area of skepticism highlighted in the bearish analyst notes.
Yes, SBC is a massive point of friction between tech management and institutional value investors. Tech companies utilize massive stock grants to attract and retain elite engineering talent, especially when competing against trillion-dollar hyperscalers like Google and Microsoft in the AI arms race.
The sources highlight that ServiceNow is currently issuing a staggering $1.95 billion in annual stock-based compensation.
While that allows them to hire the best AI engineers in the world without draining their cash reserves, it creates a massive hidden cost for the investors.
Issuing $2 billion in new stock every year aggressively dilutes the ownership percentage of existing shareholders. It essentially acts as a massive, invisible tax on the stock price.
Institutional investors ruthlessly scrutinize true GAAP profitability, generally accepted accounting principles, which forces companies to deduct that massive SBC expense from their bottom line, often turning a supposedly profitable adjusted quarter into a GAAP loss.
Management is acutely aware of the market's frustration with the dilution. They have stated a long-term strategic goal of driving SBC down to a single-digit percentage of overall revenue.
Furthermore, to aggressively combat the dilution, the board authorized a massive $5 billion share repurchase program back in January.
They are essentially using their cash flow to buy back their own stock on the open market, offsetting the shares they print for their engineers.
But until that SBC number shrinks significantly, it remains a persistent heavy anchor on their valuation multiple.
The final existential risk we need to unpack is the rapidly shifting regulatory landscape. If your stated corporate mission is to build an autonomous AI control tower capable of running the physical and digital operations of massive corporations, you instantly place yourself in the crosshairs of global regulators who are terrified of unchecked AI.
It is an incredibly delicate high-wire act. On one side of the Atlantic, you have the European Union, which has enacted aggressively complex, heavily punitive frameworks like the EU AI Act and the EU Data Act.
These frameworks place incredibly strict, legally binding requirements on data portability, mandate absolute transparency regarding how AI models make decisions, and open up massive corporate liability regarding AI bias.
Operating an autonomous agentic framework in Europe requires an immense, costly layer of compliance overhead to ensure the AI doesn't accidentally violate consumer rights or make biased automated HR decisions.
But on the other side of the Atlantic, the regulatory environment is completely different. The sources note that CEO Bill McDermott has been incredibly vocal, explicitly praising the current U.S. administration's approach to AI regulation, characterizing it as a lighter touch.
He is actively lobbying the narrative that less bureaucratic regulation and more open innovation are exactly what the enterprise software industry requires to drive the next massive leap in global efficiency.
The tension is stark. ServiceNow is attempting to build a unified global platform that possesses the rigorous, localized compliance mechanisms necessary to survive the strict mandates of the EU, while simultaneously capitalizing on the rapid, lightly regulated, move fast and break things innovation environment fostered in the U.S.
A misstep in either direction, stifling innovation to please Europe or violating data laws to chase U.S. growth, could result in massive fines or loss of market share.
Which brings us to the grand synthesis. We have unpacked the foundational single-tenancy architecture. We explored the zero-copy data fabric and the aggressive M&A blitz assembling the autonomous hands of the platform.
We analyzed the financial beat, the temporary margin pain of the $4 billion debt load, and the macroeconomic storm clouds of geopolitics and regulatory friction.
Pulling all of these complex threads together, what is the ultimate trajectory of this company? Where are they actually pointing the ship?
They are pointing the ship at a fundamentally, radically expanded financial universe. Historically, the total addressable market, the TAM, for traditional IT service management software was highly lucrative, but it was bounded.
It was largely confined to the IT department's budget.
By aggressively expanding their capabilities into generative AI interfaces, enterprise-wide identity governance with Veza, and physical operational technology with Armis, they are no longer just fighting for the CIO's budget.
They are targeting a staggering TAM of $600 billion.
And the financial analysts and the sources note that this $600 billion figure might be conservative. Analysts at Benchmark, who recently initiated a strong buy rating on the stock despite the 40% six-month drop, believe the underlying architecture is positioning ServiceNow for a TAM expansion well beyond $600 billion.
Perhaps quietly inching toward a $1 trillion roadmap over the next decade.
The mathematical justification for that trillion-dollar ambition lies entirely in the strategic acquisitions we discussed. The seamless integration of Armis and Veza alone is projected to more than triple ServiceNow's addressable market, specifically for enterprise security and risk solutions.
By crossing the chasm from digital IT tickets into physical operational technology, they are actively fighting for massive industrial budgets.
The factory floor automation budgets of automakers, the sprawling supply chain logistics budgets of shipping giants, and the critical healthcare operations budgets of national hospital networks.
The Trident Care example, buried in the final pages of the source material, perfectly encapsulates the reality of this TAM expansion.
Trident Care is a massive provider of portable medical diagnostic services. They don't just deal in data, they deal in physical machines and human patients.
They integrated ServiceNow's AI platform across their field service management and sales CRM systems. The resulting efficiency gains are staggering.
They achieved 96% complete scheduling automation across 127 different geographic markets.
The volume of manual scheduling for complex medical diagnostics plummeted from 50% down to just 4.3%.
Human dispatchers are no longer wasting time matching calendars. They only intervene in highly complex edge cases where nuanced human judgment and empathy are genuinely required.
They achieved a massive 30% operational efficiency improvement on day one in their very first deployment market.
When you look at Trident Care automating 96% of their medical scheduling or telecom networks healing themselves, you realize ServiceNow isn't just tracking work anymore. They're actually doing the work.
And that is the ultimate paradigm shift from a passive system of record to an autonomous system of action. A traditional system of record is essentially a highly organized historical database. You log into it to see what happened in the past.
A system of action is an autonomous engine that observes the present, calculates the variables, and executes the physical and digital steps necessary to shape the future.
The overwhelming consensus and the strategic outlook provided by the analysts in the sources is that Despite the temporary margin compression and the geopolitical headwinds, ServiceNow is rated as a high-conviction core holding.
It is certainly worth noting, as a final piece of evidence regarding internal confidence, that CEO Bill McDermott recently executed a massive $3 million open market purchase of the stock out of his own pocket.
It is a profound signal of immense personal conviction in this exact aggressive roadmap. They are ruthlessly cementing themselves as the unavoidable operating system for the enterprise AI era.
It is an overwhelming amount of data to process. From the intricacies of single-tenancy architectures managing 95 billion workflows, to the financial gambit of a $7.75 billion acquisition, to the profound implications of self-healing autonomous networks.
But as we wrap up this analysis, I want to leave you with one final, deeply provocative thought to mull over as you digest the implications of this transition.
Let's hear it.
If we truly have crossed the Rubicon into an era where an interoperable autonomous AI workforce can instantly detect a microscopic mechanical failure on a factory floor, autonomously check the global supply chain inventory, secure the replacement part, dispatch a certified human technician, and then fundamentally rewrite its own operational protocols to ensure that specific failure never happens again, at what exact point does the platform stop merely running the workflows of the company and begin actively, strategically managing the company itself?
Risk defined. Portfolio protected.